Mark Connolly and Rick Ray are registered representatives and financial advisors with Park Avenue Securities, a registered broker deal and investment advisor. The information you will hear on this show is for information purposes only, and individual situations vary. The information should be relied upon only when coordinated with individual professional advice.
We are back. Big Money, Big Daddy on AM 1130. So I talked a few minutes ago, and again, this is Justin Makris, Wealth Design Group. We talked just a few minutes ago about what is going on in the world that we exist in, how is that going to affect us long term, and I gave you kind of some general foundational things, some principles, some guidelines, and now I want to kind of go into that with a little bit more detail. Before I do that, though, again, you're listening to Big Money, Big Daddy. You have any questions or comments, you can call us at 713-826-0426. You can text us text daddy to 72727. Should have specified that last time. Text daddy, D-A-D-D-Y, to 72727. Or you can Facebook us at Big Money, Big Daddy. So with that being said, foundationally, no matter what happens in this world we exist in, no matter who our presidents are, no matter what's going on, if you stick to the core principles and the core foundational pieces of investing, you understand them and you stick to them, life will be good. And those, again, are you want to own equities, you want to diversify, you want to rebalance. That's really the first core one. You want to understand that returns in the market come from the market, not an individual. There's no one person or a group of people out there that are generating these returns. They come from the market naturally. We as the consumers are creating those returns, right? And the reason why, third principle, is free markets work. No matter what's going on out there, no matter if there's volatility in the short term or there's crazy stuff that's going on, whether it's Brexit or an election or oil, all the stuff we've seen this year, and that's really only resulted in positive returns, as you can see over the year, it's all going to be good. Free markets work. They always do. Other foundational pieces and principles are engineering matters, as in engineering the portfolio. The math and the science trump all day, every day. Execution matters, and then working with a coach matters. Those are things I'm going to be covering in that third segment. And then the final one is really hard easy, practicing financial hard easy, meaning you want to do the hard things first. You want to do the foundational things first. You want to talk about risk and how bad can a portfolio get so that you can position yourself to capture positive rates of return over time. Not be another statistic, which unfortunately, which I mentioned last segment, I'll re-mention again, is Dalbar, a company that does research, has pointed out that over the past 30 years, so this isn't a 1-year time frame or a 5-year time frame, this is an average over 30 years, that the average investor inside of equity funds, mutual funds, active managed funds, is getting less than 4% in the market, while the market, measured by the S&P 500 in this example, is up closer to 11%. So again, we've got a problem, right? There is a huge gap in the amount of wealth that someone should be receiving and the amount of wealth that they are receiving. So with that being said, let's talk a little bit. Let's spend this second kind of talking about the gloom and the doom and the unfun stuff. But really, what causes those returns? Why are people not able to consistently get good returns in the market when the market is always producing? If you look at any rolling 10-year period in the market all the way back from the 20s, and what I mean by a rolling 10-year period is like 1925 to 1935 or 1940 to 1950 or 1988 to 1998 or 2002 to 2012, which was a bad 10-year period, right? Or 06 to 2016, where we are now. You look at any rolling 10-year period, you have never not received positive rates of return in the market above inflation. Never. So why is it people don't see that? Why is it when you talk to people, all they seem to talk about is, man, I can't seem to make money in the market. I can't seem to trust my advisor. I mean, it's up one day, it's down one day. I mean, what is going on? Well, we've done some research, we've done some studies, and we've looked at it that there's really 4 core things that people are doing that they think create value, but do not. I repeat, people think they work, but they do not. We call them our myths to investing. Like any good myth, it's kind of this idea that this may exist and this would work, kind of like Bigfoot. Kind of like Loch Ness Monster. I still am kind of hoping those things do exist, but I think at this point, I have to admit they do not. With that being said, those are kind of the 4 myths to investing. And the first one, and one that obviously a lot of us do. And I will tell you personally, I've done 2 of these myself when I was trading. I started off trading. I did one of them for my client when I started off working with Morgan Stanley. And I was a victim of the 4th one just because I was unaware of it. So I am right in the same boat that all of these other people are in, but you can get out of it and get into a better situation. So the first one that I definitely did when I was trading, stock picking. So what is stock picking? Stock picking is simply the idea that somebody, whether it's an individual or a firm or whatever, knows what stocks you should pick because they know they're going to go up versus other ones, right? What stocks you should pick versus what stocks you should not pick. So I feel I should own Apple and I should sell my Exxon stock. Or I feel I should own Google and I should sell my JP stock, right? At the end of the day, the idea that stock picking works, that somebody knows what stocks you should pick and why you should pick them. Unfortunately, ladies and gentlemen, that does not work. There is nobody out there that knows what stocks you should pick, and that has been the case for years, and the proof is in the pudding. So if you've ever heard of a mutual fund or an actively managed fund, what a mutual fund is, and I kind of use that as my comparison, what a mutual fund is at the end of the day is a fund that's been put together that has a bunch of different stocks in it that a mutual fund manager or somebody thought would go up compared to all the other hundreds or thousands of other stocks they could have put in there, right? So at the end of the day, a mutual fund is designed to outperform the market. A mutual fund is designed to do better than if you're just to own the market. You isolate and you pick those few stocks that are going to do well. Well, why don't we compare what the average mutual fund has done compared to the market? So I've got a chart in front of me, and you can kind of look at this yourself. I would say go have fun and pretty much put any one of your mutual funds you've ever seen into google.com/finance or bloomberg.com or whatever tool you want and see how is it done compared to, let's just say, the S&P 500. And you'll see there's a pretty big difference. So what we decided to do is if you had $100,000 and you invested it from 1972 to now, that $100,000 inside of the average of all U.S. mutual funds would have grown to about 3.1 million. So not bad. I'd take it, right? Problem is, and this is also the problem with statements, traditional statements, is it's not, you get a statement that says, hey, you made this money, you made 3%, you made 4%. Problem is, it doesn't tell you what you should have made, right? It says you made 4 when really the market was up 12. So if you were to compare the average of all mutual funds, $100,000 growing to 3.1 million, to just the S&P 500, which I told you in the first segment, engineering matters. So this isn't even engineering a portfolio. We can even do better than this, but just compare to just the S&P 500, which is a measure of a market, large U.S. companies, it grew to 6.3 million. So you doubled your return by simply owning the market instead of trusting a money manager, instead of putting your money with a mutual fund. And I know that seems crazy because you're probably like, well, why are you on this radio show? Aren't you a money manager? I am, but from a different perspective. I'm here with your intentions and your goals in mind, trying to create peace of mind for you guys, not for some firm I work for or from some bank I work for, anything like that. Because at the end of the day, I believe strongly that returns come from the market, not an individual. Nobody knows what stocks to pick, right? So there is a huge gap in the amount of wealth that someone is receiving by stock picking. So our theory is don't do it. Now, I know it's hard because if you open up any Forbes or Fortune magazine or turn on the news or anything like that, stock picking is all over the place, right? Here's the top 10 stocks that last a decade. Do this, do that. So I know it's hard, but you got to understand that the huge myth to investing is that stock picking works, and I'm here to tell you it does not work. So that's kind of myth one. I think I probably beat that horse to death. We'll move on now. Second myth, and again, you're listening to Big Money, Big Daddy. This is Justin Makris here. Second myth is market timing. So this is the kind of deal where it's like, I agree with you, Justin. I know that there's not stocks you can pick, but I have a good feeling of when to get into the market and when to get out, right? And that's market timing. That's the whole, hey, Brexit's about to do this, I think I need to get out. Or oil's going down, I think I need to get out. Or whoever's going to become our next president, I think I need to get in. Or I think I need to get out. I mean, there's always something in the media that says to you, now you should get out, or now you should get in. But I'm here to tell you that nobody, just like stock picking, knows when you should get in and when you should get out. There's a reason why if you turn on CNN or Fox Business or any of those, and you'll see one guy yelling, you got to get in, buy, 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 buy. Then you got another guy yelling, oh, you're crazy to get in. You got to sell, get out, get out, get out. The hope is one of them gets to come back in 6 months and say, I told you so. Oh, by the way, buy my fund, right? And that's just the game we live in. But the truth is, and the proof again is in the results, nobody, I repeat, nobody knows when you should get in or when you should get out of the market. In fact, the best stock pickers in the world and the best market timers in the world only outperform the market 20 to 30% of the time every year. And then I'm going to show you in just a second that those are a different group of people, so you can't assume that they'll be doing it next year. So at the end of the day, and what I said back to kind of that core value that returns come from the market, not an individual, really just emphasizes that nobody knows when to get in and when to get out. And I'll tell you, I wish they did, because if they did, we could all just invest with him, right? And personally, if I knew, I don't know, I may be kind of selfish and keep that information to myself and just kind of double my money every day and on some island I bought myself, right? No, but at the end of the day, nobody knows when to get in and when to get out. So instead we say, don't play that game. Now, you have to be careful though, because there's a lot of things out there that are market timing in disguise that people think, oh, well, this sounds smart, but at the end of the day, it's just market timing. So for those of you who've ever heard tactical asset allocation, if you've ever heard tactical asset allocation, you need to text Daddy to 72727 or call us right now at 713-826-0426, because that is something you need to run from. That is something that sounds really, really cool, sounds really fancy, but at the end of the day, does not work. So, stock picking market timing does not work. Third myth is track record investing. Now, remember I just said 30% of money managers, only 20 to 30% of money managers outperform the market. So your response to me could be, well, why don't I just go invest with them, right? If there are 20 to 30% of managers out there that do outperform the market, well, heck, I'll just work with them. Problem is, it's a different 20 to 30% every single year. So we've got a study here that shows essentially what would you compare the top equity fund managers compared to the market over a 10-year period, and then what does it do the next 10-year period? Huge difference. Huge, huge, huge difference. We can show you those numbers if you ever want to sit down with us. But there's zero correlation to performance in the past to performance in the future. And these big money management firms know that. That's essentially why Fidelity and Schwab and Vanguard has 1,000 funds, because they know some are going to do well, 20 to 30% of them, and some won't. And the ones that do well, they just market the heck out of those. And the ones that don't, they just get rid of them, right? But at the end of the day, the proof is that there is not one individual or one money manager or one strategy that works to consistently outperform the market. The only way that you can capture market rates of return over time is to be in the market. And again, stick to those core principles as I was telling you about, which again is returns come from the market, you engineer, you execute, and you work with a coach. And that's what I'm going to cover next segment. Fourth myth, final myth, and it's just a quick comment, is cost. Cost is a real thing inside your portfolio, and there's not only an expense ratio or disclosed cost, I like to call that, a cost you're aware of, but there's a lot of hidden cost as well, and a lot of it comes with buying and selling and the activity that happens inside of those funds that you may or may not be aware of, but cost is a real thing that erodes away your portfolio, and if you compare an index fund to an actively managed portfolio, the cost could be 2 to 3 to 4 times greater. So at the end of the day, not only does it cost more to work with active management, but active management implements things like stock picking and market timing and track record investing, which again does not work. So I know I've just spent 15 minutes kind of talking about all the bad things you shouldn't do, and that's definitely not the way to end it. So we're going to come back after the commercial break and we'll discuss kind of the solution to that. Because at the end of the day, there is a way that you can be invested in the market and you can essentially get great rates of return. So that's what I'll cover in this next segment. And again, this is Justin Makris, Wealth Design Group. You're listening to Big Money, Big Daddy. And if you have any questions, comments, or would love to reach out to us, again, you can call us at 713-826-0426. Or you can text Daddy, that's D-A-D-D-Y, to 72727. That's probably the easiest way to get in touch with us. Or hit us up on Facebook. We're always updating and putting up our coaching events. We've actually got an event tonight. at Perry's Memorial City tonight at 6:30. If you guys want to last minute come to that. But yeah, you can check us out on Facebook at Big Money Big Daddy. And looking forward to kind of going over the solutions with you after this commercial break.